Here is your weekly market workout script for this past week's market activity. This week's market action was like chasing a pump that just won't stick. You get the flash, but you're still waiting on real growth. Let's start with equities. The S&P 500 added 2.9% last week, but don't get too excited. The bounce wasn't from earnings or fundamentals. It was mostly hype around potential trade deals. The administration hinted at near-term announcement, with India mentioned by name. But big names like China and the EU are still in negotiation limbo. Meanwhile, volatility's been running hotter than your shoulders on the drop set. The VIX index remains well above average, and the strategists are bracing for more chop as tariffs, inflation, and central bank policy remain in play. On the fixed income side, BBB rated corporate bonds are slipping on interest coverage, even after a solid 2024 earnings. Rising refi costs are squeezing margins, and selectivity is now critical, especially in cyclicals. In real assets, REIT performance continues to be fragmented. Data centers and industrial centers are still the golden children. Telecom REITs? Still benched. The 5G play and rate cuts could help later, but for now, it's neutral. In alternatives, small and mid-cap private equity is looking strong. Structural advantages, improving exits, and favorable debt market makes this a standout sub-strategy heading into the back half of the year. Coming next week, all eyes on inflation data to gauge if the Fed might start cutting rates before year end. And we're going to keep watching tariffs. Any deal headlines could swing markets quickly, especially sector-specific news on pharma or semis. And with earnings season slowing down, expect macro to retake center stage. Final set, stay tactical, focus on quality. The noise is high, but if you stay lean on hype and heavy on fundamentals, you'll be ready when the real gains show up. Drop a like or a follow if you like this crap. Stay profitable and God bless. Have a good weekend.